Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Apple.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. I think the story with Apple, the real fundamental story, isn't just about selling more phones anymore. It's a structural shift.
A shift towards profitability.
Exactly. It's all about them becoming this integrated high-margin platform company.
And that idea is, it's perfectly encapsulated in the services segment, right? That division has become an absolute financial powerhouse.
Oh, for sure. We're talking about, $28.8 billion in revenue just in the last reported quarter.
That was Q4 of fiscal 25.
Right. And that number, that $28.8 billion, isn't just big. It represents 15% year-over-year growth.
Which is way faster than the rest of the company's growing.
Way faster. And if you annualize that, you're looking at a business that's getting really close to $110 billion a year.
Mm-hmm.
It just fundamentally changes the entire risk profile of the company.
It changes the profile because of the margins. That's the key.
Yes.
Most hardware companies, they operate on these razor-thin margins.
Mm-hmm.
But services, you're talking about gross margins above 70%.
70%.
Yeah.
And a company known for physical products, that's like having a permanent subsidy for your entire profit picture.
It's a structural tailwind.
It is. It just keeps boosting the company's overall profitability quarter after quarter. And the foundation for it is it's huge.
What's the latest on the install base?
Well, the company now has over 1 billion paid subscriptions running on top of an incredible 2.3 billion active devices.
That's the kind of user base that just provides incredible durability.
It does, and you can see that throwing right through to the main numbers. The overall revenue for Q4 hit a record $102.5 billion.
But it's the forward-looking guidance that was really surprising. Management seems incredibly confident about the holiday quarter.
Exceptionally bullish. They're guiding Q1 of fiscal 26 revenue to grow 10 to 12% year over year.
For a company of this scale, that's a staggering ambition.
It is. They're aiming for the strongest holiday quarter on record. And they said specifically that it would be driven by double-digit growth in the iPhone segment.
So the new models are selling really well.
It seems so. And beyond just that top-line growth, the margin story is just as important.
Right, the gross margin outlook. They guided that to, 47 to 48%?
Yes, very high.
So how are they pulling that off, with supply chain costs and everything else going on?
It's really two things working together. First, you have more of that ultra-high margin services revenue in the mix. When that segment grows fastest, the whole company's margin profile just gets pulled up.
Okay, that makes sense.
And second, it's the huge success they're having with their own custom silicon.
The M-series chips.
Exactly. In the Mac and the iPad.
So by making their own chips, they control costs better, but it also lets them, fine-tune the performance and efficiency.
Precisely. That operational efficiency is sort of the secret sauce here. It's why analysts expect EPS growth, earnings per share, to actually outpace revenue growth.
So for every new dollar of revenue, more and more of it is falling to the bottom line as profit.
That's the idea. They're capturing more profit on a per-share basis.
And when you have that much profitable growth, the amount of cash you generate is just immense. Which brings us to the balance sheet.
A major pillar of the whole thesis, and sometimes people overlook it.
It's rock solid.
Absolutely rock solid. Even after years of returning tons of capital to shareholders, they still have a net cash position of around $34 billion.
And that financial strength is what lets them do these massive capital return programs.
Right, which is one of those powerful parts of the story.
Let's talk about the latest one. They just announced a staggering $110 billion share buyback authorization.
It's not just big. It's one of the largest corporate share buybacks in history.
And they threw in a dividend increase as well.
Yep, a 4% increase. Takes the quarterly payout to 26 cents a share. But let's stick with that buyback. That $110 billion number provides a really strong, almost mechanical floor for earnings growth.
I hear that phrase, earnings lever, a lot. Can you break that down for our listeners? How does a buyback that big actually work as a lever?
It's just pure math, really. When the company buys back its own stock, the number of shares out there in the market goes down permanently. Okay. So if your total profit, your net income, stays the same or keeps growing, dividing that profit by a smaller number of shares automatically magnifies the earnings per share.
So even if, say, the iPhone business only grows 5% next year, the EPS could still be up double digits just because they're retiring a few percent of the stock.
Exactly right. It juices the EPS growth, which makes the stock look cheaper on a forward earnings basis. It's also how it buffers against something called multiple compression risk.
Okay, another key piece of jargon. Define that for
Sure.
us.
Multiple compression is just the risk that investors will decide to pay a lower price for every dollar of earnings, a
Mm,
lower PE ratio.
right,
Maybe because they think growth is slowing down.
right.
Apple's buybacks artificially boost the E in PE, which helps justify the current valuation even if top-line growth cools off a bit. It's a mechanism for stability.
So this whole engine, the cash flow, the buybacks, it all comes down to that competitive advantage. Everyone calls it the ecosystem lock-in.
Mhm.
But let's challenge that for a second. I mean, Spotify, Netflix, they work just fine on Android. What makes this moat so sticky?
I think it's multi-layered. It's not just about subscriptions. It's really built on two things:
Mm.
high switching costs and vertical integration.
Okay, switching costs.
The switching costs are all the little pain points you'd face if you tried to leave. I mean, we've all thought about it. Trying to move a decade's worth of iCloud photos and iMessage history,
Hmm.
that's not a simple task.
It's a multi-day project that you just never start.
Nobody wants to start it. That's the friction. It's the invisible cost of time and hassle.
And the vertical integration is the glue holding it all together.
It's the functional glue. It's how your watch unlocks your Mac and your AirPods just seamlessly switch from your iPad to your iPhone.
The competitor can't replicate that.
They can't because they don't control the hardware, the software, and the services end to end.
And the technology that keeps making that moat stronger is their custom silicon. The M-series chips seem like a really critical piece of this now.
They're absolutely central. The M-series chips don't just help with margins. They're creating entirely new reasons for people to upgrade, especially in the Mac line.
Right. Users coming from older Intel Macs are seeing huge performance jumps.
Enormous jumps. And that's driving an upgrade cycle that lets Apple keep its premium pricing against all the PC rivals who are still just trying to piece together different chips and software.
So let's shift from today's business to tomorrow's. The big catalyst everyone's watching is, of course, AI.
It is. It feels like a necessity for their platform's future.
And they're calling it Apple Intelligence.
Right. And the key timeline to watch is Q4 2025. That's when they expect this intelligence to be integrated across 100% of their products.
Which analysts think could kick off what they're calling an AI supercycle? What does that actually mean?
The idea is that the best, most useful new AI features will need so much on-device processing power that only the newest chips can handle them.
So the M5 chips, the chip in the upcoming iPhone 17.
Exactly. Those devices have things like upgraded neural engines that are needed to run these complex AI models locally on the device, which is better for privacy and speed.
So if you have a 4-year-old iPhone, you might find you just can't access the cool new features. It basically forces you to upgrade if you want the best experience.
That is the entire premise. It's designed to boost retention, increase use of the high-margin services that feed the AI, and, yes, force a hardware refresh.
And there's speculation they're trying to speed this all up, right?
Yes, there are some pretty strong, though still speculative, rumors about a potential partnership with Google's Gemini.
To get a faster, broader AI rollout.
Right. It suggests they're willing to partner up rather than just wait on their own internal timeline. And we're seeing the ecosystem expand in other ways, too, like GM putting free Apple Music in its new Cadillacs.
Okay, so shifting gears from the fundamentals to market sentiment. How are the big institutional investors positioned here? Are they still all in?
The short answer is yes, overwhelmingly. Sentiment is very constructive. You might even say bullish.
And you can see that in the ownership numbers.
You can. Institutional ownership is around 68%. So 2/3 of the company is held by professional managers who see it as a core long-term holding. We've even seen firms like WT Wealth Management increase their stake recently by almost 9%.
That's a strong signal of confidence.
It is, and the analysts on the street are confirming that view. We're seeing a lot of upward price target revisions after that strong guidance.
Morgan Stanley, for example.
Right, they raised their target to $315, and the average analyst target is now sitting around $282.
Which suggests the street thinks there's still more upside, that the services and AI stories aren't fully priced in yet.
That's the thinking. And technically, the chart seems to back that up.
For those who follow the charts, what are you seeing?
You're seeing a classic healthy uptrend. The stock has been making higher highs and higher lows, and importantly, it's in what's called a golden cross phase,
Where the 50-day moving average is above the 200-day.
a very bullish long-term signal for technicians. And it looks like solid price support has formed down around that $200 to $220 level.
Okay, but before we get too carried away, we have to talk about the risks. What's the bear case here? What's holding the stock back?
I'd say the number one risk right now is geographic, specifically China.
Sales are still a weak spot.
A persistent and notable weak spot. They were down about 4% in Q4. And this isn't just a temporary dip. It feels more like structural pressure.
From the local competitors, right?
Precisely. Brands like Huawei, Xiaomi, they're gaining market share, even at the premium end. That's a real headwind in what has historically been a critical growth market.
And the other risk, the one that made recent headlines, is about personnel.
Yes, and this one might be more worrying long term. There are reports that their chip chief, the person who oversees that whole custom silicon roadmap, is thinking about leaving.
Wow. Given how important the M series and the future AI chips are, that's a genuine concern.
It is. It puts a question mark over their long-term execution on their single most important competitive advantage.
But the company is trying to mitigate these risks, aren't they?
They are. On the China front, they're aggressively diversifying their manufacturing out to India and Vietnam. That doesn't solve the sales problem, but it stabilizes the supply chain.
And on the personnel side?
Look, key leadership change is always disruptive, but Apple has very deep engineering benches, and these product roadmaps are set years in advance. Plus, as we discussed, that $110 billion buyback acts as a huge financial buffer against any bad news.
They can afford to stumble.
They can literally afford to stumble.
So let's bring it all home. What are the immediate catalysts we should all be watching for over, say, the next 3 months?
The single biggest one is the Q1 earnings report. That's coming in late January. That will be the moment of truth for the CEO's aggressive holiday quarter guidance.
We'll see if the double-digit iPhone growth actually happened.
Exactly. On the product side, I'd watch the smaller updates, like the rollout of iOS 26.2. It has new CarPlay features, which just signals more progress in getting their services into new areas, like automotive.
And you can't ignore the macro picture.
Absolutely not. Any hint of Fed rate cuts is a huge tailwind for a cash-rich tech stock like this. And keep an eye out for any supply chain news, maybe an expanded relationship with a foundry like Intel to get some of those TEACH Act subsidies.
So when you pull it all together, you have this unbreakable ecosystem, a massive buyback acting as an earnings lever, and this accelerating high-margin services business. It really paints a clear picture.
Absolutely. This analysis really helps you see that it's not just a hardware refresh story anymore. It's an integrated platform that's, perfectly positioned for this big shift to AI and for continued margin expansion.
Despite those risks in China.
Despite the risks, I think the real question for the next year isn't about their moat. It's about whether their internal culture can deliver this Apple intelligence leap before competitors, maybe through partnerships, make their hardware feel irrelevant. That's the real tension to watch.
A great point to end on. If you want more insights like this delivered daily, make sure you subscribe to Smart Wealth with Joshua.